Well, make sure you introduce your
Here, you want to sign this? Negative arms.
All right, my name is Anna Moore, and I'm here with Kruszeski, and we're pitching NRGV, Energy Vault Holdings. So we're recommending a purchase of Energy Vault Holdings as a long-term buy. So I did 2 DCFs. The first one is 12% above consensus for forward year 24 and 6% for forward year 25. So when choosing a company, I originally chose a different company on a lithium-ion battery company. However, I came onto Energy Vault Holdings, which seemed a lot more interesting, and I didn't know anything about gravity-based energy storage. So when I was looking more into it and researched more about it, it just seemed like a really cool way to implement renewable energy in a more cost-efficient and more durable way. My most common question was about the G10 chart and how it spiked down a little bit. So this was due to the announcement of the contract with China. So they're making 100 million megawatt device in Shanghai, and consensus was a little weary because this company was made or founded in 2017, so it's fairly new. So they have this is their first time choosing and building this device. So consensus was a little weary on that. So we'll open the floor to questions.
Okay, questions. So if I can start, so you had 2 DCF models. Why would you have a 5-year and a 10-year? I guess, why do they differ?
Yeah, so I'm pitching this as a long-term buy because of the year of the consensus. For the short term, there's no big catalyst that'll make it jump in the next 1 to 2 years. So I did a 5-year just to see if India will contract Energy Vault Holdings within the next 3 to 4 years, like the industry experts I spoke to said. And then I did a 10-year DCF model just to double check if India took longer than the 3 to 4 years of expected, and also if China were to expand more on that. So I wanted to do a more long-term basis and look at it more short-term as well.
Okay, good. And the second question is, you spoke to some industry experts, which is awesome. What did you learn from them that helped you forecast better?
Yeah, so definitely the catalyst of India moving, and then the 2 industry experts I spoke with were from China, so where the device is currently being taken place. So they also said that China's looking to integrate more renewable energy into it, and they also want to be carbon neutral by 2060, which seems like a long time, but when you look at China, it's more densely populated and has the highest population, so it is going to take a longer time for them to be completely carbon neutral.
Okay, great. So basically on China. Other questions?
What's the price difference forecast between the 5 and 10-year DCF?
So my 5-year was, my 5-year price target was $8, and my 10-year DCF was $23 from yesterday's closing price.
Wow. So I thought what you said was in the 10-year, you accounted for in the 5-year. Correct me, I think I misunderstood. In the 5-year, you said you assumed India would come on board within the 5-year window and model that into your DCF.
Yes.
And in the 10-year, you assumed it wouldn't happen in the first 5 years, it would take longer.
Yes.
So if cash flows happen later from now than now, would you normally expect the value of those future cash flows to be more or less in present terms?
If it started in, let's say.
So if I said I was going to get $100 3 years from now, or I was going to get $100 7 years from now, which one would you rather have? Yeah. And so if I modeled India cash flows in the first 5 years, those cash flows should be more valuable from my perspective here. So what's driving this massive difference between 8 and 23? That doesn't make sense to me inherently. Can you help me understand that?
Yeah, so I also, for my 10-year DCF, I added India, China, and also they did an SEC filing in February 2022 that had 17 patents with other countries and 4 among the US. So I also included those 21 countries that were going to be.
Okay, so it has a whole bunch more revenue in the 10-year DCF than the 5-year. It's not just the India timing's off. It's got it's actually a completely different model.
Yes.
Okay.
Yeah, and I was going to wait until Hannah was done, but this is to kind of cover this question. I think 3 of you have startups that you're pitching this week. And when you're going to do a startup, you generally are not going to do just a 5-year DCF. Because keep in mind the DCF, the last year, your terminal year, we call it terminal because like your company was dead. Like you're only going to grow a little bit, like 1.5% from that point forward. But if you got a company that it was just this happened to at least 3 students this week and some others earlier this semester. If you've got a company that's not really going to start to ramp for another 5, 6, 7, 8, maybe even 10 years, like Tesla 5 years ago, if you're looking at it, you got to go all the way out. And the terminal year should really be the year when you think from that point forward, the company's mature. They're only going to grow at 1.5%, 2% a year. And so what I think you just illustrated is that you said, look, this company is not going to hit a wall and not grow anymore after 5 years. It's probably like 10 years. The one downside to that is if you go to a portfolio manager and you say, you got to buy the stock, the way I get to my price target is with a 30-year DCF, they're going to say, whoa, because that is a way to manipulate some of that as well. So you got to kind of strike some middle ground. Other questions for Hannah?
Yeah, so I mentioned this on detail a little bit, but there's been a handful of like short reports coming out this year because they SPAC in like February. And apart from like the founders and like all the SPAC issues and everything, the biggest contention is that the technology just like doesn't make sense. Like physicians will say like it just doesn't work, and it's like a Theranos kind of a pitch. I'm not trying to like sack your pitch or anything, but like why is this more effective than like windmills or like water pumps, or like how does it work well?
So you can choose how much megawatts you want. So China right now chose 100 million megawatts, and right now the device is inside a glass container, or not glass container, it's in a container that'll be shielded from outside resources during construction. And then I briefly mentioned how they tested it. It's hurricane and earthquake proven. This is made by the California Institute. So it's also made with recyclable concrete. So the concrete used is durable and also it's metal. How the device actually works is almost like a Levi system, where how fast it goes, it'll produce the most energy. Again, we will have to see when they finish the device in 2023. However, they completed all their testings and procedures, and there was nothing wrong with the device. So that answers your question. Or?
Yeah.
Do they have warrants since it was a SPAC?
I was not able to find anything on that. Someone else asked the question. Alex.
Oh, great job, Hannah. I was wondering, I asked this on D2L, but I was curious for more clarification on the steps towards profitability.
Mm-hmm.
When do you have that forecasted? And I understand 2 different models, and in each of the models, and kind of when can we expect this to start being profitable and free cash flow positive?
Mm-hmm. So in my 5-year DCF, I have it being profitable in 2024. In my 10-year DCF, I have it being in 2026.
Other questions? Okay, great. Okay, who's next, Margaret?
Jack.
Jack?
Unless this Basil has an interview or
I just had an
something.
interview at 2:30, so I was like, I don't know how long that's gonna take.
I think we'll get like 2:30.
Okay, all right, cool.
But we'll give you, Chris, I won't give you go. Are you last?
Or yeah, I think it goes Jack and then Grace.
Actually, I want to see Jack go. Let's go, Jack! Yeah!
Chris, if you get close, then but I don't think I don't let this drag on after the wall. I'm going to try to keep it going.
Oh!
He's got to get out of here too.
I like to ask real questions.
Oh.
Okay, so take it forward.
So hi, I'm Jack. This is my mentee.
Hey, Catherine.
I'm pitching Academy Sports and Outdoors Corporation, ticker ASO in the consumer discretionary space. Usually don't cover that, but talking with Dr. Valentine, he opened it up to let me kind of go and see what I wanted to do out there, and thought their G10 chart really showed me some things that I thought that was really undervalued, and looking at it has some real potential in the future. Let's see what I was asked a lot on D12 about the 622 price drop. I think that was mostly due to like macroeconomic trends at the time. If you remember, like inflation numbers were coming out in like the 9s, and the Fed was talking about like 100 basis points hikes for a really long time, which we've obviously gone through. And that was not like earnings related at all. So there, if you look at the G10, all of that is in like the price going down due to market being more negative on the economy rather than the market being more negative on their earnings outlook in the future. So that I'll open up to questions.
So I think your thesis is that you expect sporting goods to continue to do well. You mentioned hiking in your slides. So I guess my first question is, why did you focus on hiking? I guess how much is hiking as a percentage of their total revenue?
Yeah, so hiking is actually like the #1 like outdoor activity in America. If you believe that, but
It's kind of walking, isn't it? I mean,
yeah,
sorry,
it-
but hiking and like go for a walk, right? But I guess walking up a mountain or a hill is all kind of.
yeah, it's like the same thing. But, as a percentage of revenue, the outdoor activities market makes up 32%. Obviously, there's other activities more in there with just hiking. So, but yeah, it makes up like 32% of revenues is the outdoor segment, which is like hiking.
So 2/3 are not hiking related or not outdoor related.
Yes.
Because then I'm going to go to the next question, because part of your thesis is that you think that the sell side of the consensus is overly concerned about things not growing in the sports equipment. And you look at Peloton, the stock's down 80% year to date. Look at Nautilus, is down 90%. So the year to date over the last 12 months, pretty close. And there's some view that, you know, we were all pent up during COVID. We all wanted to kind of exercise and do things and spend money on that kind of thing, and we're not spending as much on it. So I guess how do you, at least, obviously you can't, the hiking part you can make the argument, but you just said 2/3 of it is not outdoors. So how do you get comfortable that the 2/3 of the business that's not the outdoor hiking and fishing and hunting is going to do well, given what's going on with Peloton and Nautilus?
Yeah, so I'd say the big thing there is that this is like recurring purchases. This isn't like Peloton where it's like a stationary bike you put in your home, right? Like these products that they're selling deteriorate over time and have to be replaced, right? Talk about like their apparel, their footwear, and things like that. Like they wear out, you have to keep buying them. So I think that's a key thing for this that differentiates them from those other COVID winners. That like they just, you know, they sold all the products to like, meet their market, and then their products don't like they last for a very long time and nobody else wants to buy them. That's a big difference I think with Academy Sports. And was there any other part of it?
Okay.
Yeah, Jack, I'm just looking at your G10 chart, and it's like one of the most beautiful things I've ever seen in my life.
Awesome.
Can you just
The chart itself or the chart of the stock?
everything? Just everything. Can you just walk me through your screening process, how you found this beauty?
Yeah, so I don't know if anybody is aware of the book called it's called The Little Book That Beats the Market by Joel Greenblatt. It's a really good investment book if anybody's interested. But he lays out kind of his thesis on how, you know, stocks should be valued, and he has this screener that I used for this. It calculates ROC and free cash flow yield a little bit differently than most normally would. It uses EBIT rather than using NOPAT to kind of get rid of some of the differences in taxes between different like companies. And he does a composite ranking of the two. So he adds together, like he'll rank every stock and then he'll add the two together. So if you ranked like 10th in free cash flow yield and then like 200th in ROC, then you're going to get like, you know, like the 220th ranking. So then, so it measures the two of them together to make sure there's not a huge difference between the two. And ASL is ranked like #1 on that marker for 3 years in a row.
So #1 among how many stocks?
Every stock. Well, okay, so you set a minimum market cap, and I set it at $1 billion, and it's been #1.
So of all stocks traded in the United States under $1 billion, this was the #1 stock.
Over $1 billion.
So
this has
over
been the
$1 billion.
#1 stock for the last 3 years.
That's your question?
Yeah.
Okay, cool. What's next?
So Grace pitched Hibbett last week, and we own Dick's. They're all kind of the same thing. So what makes this Academy better than those two? I guess.
Yeah. So yeah, this has a little bit more of that. I think part of it is where it's located in the world. It's all in the south and southeast region of the United States, where sporting activities are much more, part of the culture there. If you look at like youth sports, high school sports, look at big places like Texas, which is where most of their stores are. 100 of their 250 stores are in Texas, which is a big part of it. And then they have this like hunting and camping outdoor stuff, which like Hibbett and Dick's really don't like market to at all. So I think that's like a big differentiator between the two. We do own Dick's, and I'm looking at their G10 tart. I won't be pitching them as my sell. I looked into National Vision Holdings, and I think that'll be the sell that I pitch.
Well, as a follow-up, I was going to at some point get this question come up. Is that Hibbett stock was down 12% 2 days ago because they released earnings. Did you look into what's going on with them?
I wasn't aware of their earnings report coming out, but I know ASO's earnings
So
come
Grace
out.
knows? Do you know why they reach out?
Assuming just kind of what my thesis was that there was,
Right, okay.
because they were predicting this, or the market.
Okay. Other questions? Was someone ready to question?
Yes, from February 2020 to February 2022, they had zero store count growth. So is the future growth coming from direct to consumer, or is it same store sales growth?
Yeah, so they are now projecting, management's now looking to add stores now. They over COVID they did not add any stores, but now that that's over, they've projected to add 80 to 100 by 2026. Most of that is forecasted for the 2025 and 2026 years. So in my bull case, I have that sliding forward a little bit. In my bear case, I have it sliding back a bit. In my case, I just as added forecasted.
Catherine, could you tell us something that you learned during the appendix?
Yeah. I guess, I think the most interesting thing I found was in the Porter's forces, and I thought that I didn't really know much about forces of this market before doing this, obviously, but I think that it was really interesting that their barrier to entry of this market is, it's not so much a high barrier to enter the market, but it's a high barrier to be successful in this market. Like if you could open up a sports retail store and do just fine, but when you're next to Dick's Sporting Goods, it's gonna be a little bit harder to be successful.
Right,
Yeah.
so you need to have some sort of.
Yeah, and they're, compared to Dick's Sporting Goods, you could say that they are kind of lacking in their like network effect, just based off like how many stores Dick's Sporting Goods have versus them.
Okay, good. Other questions? Okay, well done. There's more what?
It's more than
Okay.
This is the body of the wall.
Oh, they're meant to be.
Yeah.
Okay, I think we're ready to go.
Awesome. Hey guys, my name is Grace Schwartz, and these are my mentees, Stephen and Ella, and we will be pitching Exact Sciences today with an upside of 58%. So kind of to get a little bit into my screening process, I was always pretty aware of Exact Sciences just because it's headquartered in Madison. So I knew a little bit about it, knew a little bit about Cologuard, which is kind of like their headliner product. But once I kind of started looking a little bit more into it, I thought it was really interesting that this was in a market that already kind of had a solution like colonoscopy. Colonoscopies have like very high accuracy rates, but this is kind of bringing in the at-home convenience to it with similar accuracy rates. So I thought that was really interesting. And another reason that it kind of caught my eye was after looking at the Healthy People 2030 report. And this is basically a report that kind of the American Cancer Society, CDC, Office of Disease Prevention, they basically put together a list of goals, like health goals. And in it was kind of increasing screening for colorectal cancer. And this is what it does. So, yeah. And I did want to address one thing. So on my write-up, my boxes for 2020 and 2023 were incorrect in the EPS. So the EPS that I'm pitching is correct in the write-up. It's negative $1.52. I think it was like $2.53. That's incorrect. So just open the boxes.
Okay, great. So can I ask-
Yeah, of course.
Thank you. Bryce, go ahead.
Yeah, so like you, like the past week, you were just talking like nonstop about this and like why it's a disruptive, innovative thing. Like, why is it disruptive in colonoscopy? And last but not least, for the mentees as well, do you have faith in management when it comes to disruptive technology? Because this is very new. So just can you quantify those?
You want me to go first?
No, just the mentor first.
I said once that it was disruptive technology, halfway as a joke. But I do believe that it is, and kind of already has disrupted this area because, like colonoscopies is very like well known, like between ages like 45 and 85, all people have to get them, and of the average risk like population of that, which is what Cologuard like serves to, that's 75%. So in reality, like only the 25% of high risk patients really need to get the colonoscopies. So that's kind of why I think that it is disruptive tech. It's also a lot cheaper, and you don't have to take 2 days off of work, don't have to go under, don't have to have surgery. You can all do it from home.
I just want to piggyback off of that. I think it's highly differentiated even among like competitors that are coming out with similar tests, because those require blood samples, whereas this is just a take-home test, like a fecal test. So even among competitors, this is like highly differentiated.
Yeah, that's very good. Thank you, Ella.
Yeah, and to add to that is all the management. I do have faith in the management. The chief laboratory officer has been working in labs for over 14 and 15 years at various companies. And her work has been very good as well. And so I do believe in management, and I do believe in the staff that is running the company.
I don't think they could have said that better.
Well done. Can I ask a question? So on your price to sales price target, which it shows here in your write-up of $78.34, I'm a little confused because it looks like this company has the multiple of 3.25. All the peers are below it. So if you have the peers have lower multiples and you apply a lower multiple to your company, you usually get a lower price. So how do you get upside for the stock with peers that have lower multiples?
Sorry. So the multiple that's in that bottom box is also, that has the weighting of it. So that has like the 0.2% of them being weighted.
So if price of sales is 10 for a competitor and you weighted it 20%,
Exactly.
you're showing 2
Exactly.
in the box.
Yeah, because I average those out.
Okay. And just, I'm a little confused because there's the last company doesn't have a title to it, so I don't know if that's an average.
That's just like averages of all of them. Sorry, I could label that a lot better.
Okay. Because, okay.
That's not
Just as a general rule for everyone here, you definitely want somewhere in a table, if you're gonna use multiples, to show what the absolute multiple is for your peers, so that way you can stop and go, do I think this company's a better or lower, a higher or lower multiple compared to the company I'm looking at. Okay, and then I had another question. Well, this is based on your draft, so I don't know if this is still the case, but you were above consensus for both revenue and...
Yeah, I fixed that.
Okay.
That's, yeah.
Okay, then that's my only question now. Maybe one more, but go ahead. Yes.
Yeah, I asked this on D12 like an hour ago.
Yeah, I saw it.
So, yeah, a little late. But so you forecast like Cologuard 2.0 gets more accurate. Do you forecast like other improvements in like the FIT testing or like the liquid biopsy stuff?
Yeah, so that's, kind of the improvements that are being made in the liquid biopsy tests are what I have forecasted in with the Freenome and Garden Health. And those are coming out, there was just an update in the Garden Health saying that they're going to finish theirs up in 2024. So that's kind of like being pushed back a lot farther than we thought. And I kind of looked a little bit deeper into when the liquid biopsy for Freenome would be coming in. And they're supposed to be kind of reporting results at the same time as Cologuard 2.0, so sometime this month. but kind of looking into their patents, they don't have a patent for an actual product. So this clinical study is just testing like the test and like the laboratory results. So I don't really see them commercializing and creating a product in a time period until like 2024. Does that make any sense? Okay.
Can you remind us, what is the, sorry.
Yeah.
Go ahead.
So go to the mentees first, then I'm gonna have a little bit of fun. And we'll just be with you, Grace. Don't worry. So both of you, what is the greatest takeaway I should have from the research you've done? In other words, what's the biggest revenue driver, mode, process, or did you do anything proprietary that you found out that maybe I wouldn't find out if I went to the company's earnings call, so to speak?
Sure. I think just going off of what we were saying earlier about how this product is very differentiated, especially when you compare it to a traditional colonoscopy. I think it is disruptive, you want to say that, and the fact that it's much cheaper. It's covered by like 98% of insurance. Doesn't require a blood test. What else? There's a low switching cost. Like there's no reason why you would want to choose a colonoscopy over this if you're just going for an average screen. I think it's.
And another thing that I would add is
Oh, you'll get your turn in a minute.
She's doing a great job.
So yeah, one of the economic notes I would say is the low switching cost to switch from a traditional colonoscopy to this test if you're just going for an average screen. I know you can't speak on like colonoscopy if you're like higher risk. That's when you would go for an actual colonoscopy. But with this push from the government for higher screening rates, I think this is going to be a great opportunity for this company to.
Yeah, I think with the American Cancer Society pushing their agenda for screenings for colonoscopy or colon cancer to 80% by 2026, it's going to drive more people to be getting tests, and a lot of people are going to not want to do the in-person, very expensive colonoscopy. So I think that's another revenue driver that I found that I researched.
Cool.
That's a really good one. So it's going to increase the amount of people getting screened.
So Grace is part of a CFA team that may be researching a stock like this. Grace, what is your area of expertise on that team?
What do you mean?
What are you focused on? There's 5 of you.
We like split this up actually like 2
That's
days
all right.
ago. I'm doing business description and valuation.
Awesome. So I'd love to get everyone to ask one question to Greg. Not everyone. At least one question from the audience on business description valuation. August, what's your area?
Yeah, well then can I have my partner come up here?
But you can. I'd like to have all
And
4
answer
of your
some
partners
questions.
come on up. Welcome to the competition.
We're starting
Starting now.
next week.
No.
Oh yeah. What
starting
is your
to
area of
next week.
expertise, Margaret?
I don't really remember risk.
Risk. So if you want to ask about
No.
risk, we've got a professional in the area. August, what's yours?
Valuation.
I don't think we should.
Financials. Oh yeah, this is part of the competition fund. So who else is Michael? Are you out there?
Yep, I am. I am ESG and competitive.
Okay, ESG competitive and where's our last?
Joe's right there.
There he is. What's your area?
Doing financial analysis.
All right. So I'd love to get a volunteer from one person in the audience to ask a valuation question, to ask a financial analysis, ESG. These people are being put on the spot. We will take pity, but this is typical of what you go through when you go on a team. You get hit with 50 billion questions. When they pitch for real to us in a few months, we're going to hit them with every question which way from Sundays. And I figure this is a good time to put them on the spot and hit them with one.
Yeah, let's do that. And then I would say let's just do this every Friday. Every Friday for the last 5 minutes, 10 minutes, we'll just ask them questions. So this will be the baseline. This is starting.
What do you guys got? Come on. You can whisper it to me if you're scared there's some sort of retribution.
Someone asked, why has this company not ever made money?
Oh.
Yeah, why are you pitching to buy if your company currently is pre-revenue?
Got one
And
there.
do you have any
Pre-revenue,
cash
not
flow?
pre-revenue, pre-revenue.
Well, whichever the 5
I
of you,
mean,
this is your
that's
area.
like pretty.
We're gonna get one in for
That's
first.
pretty standard for a lot of the healthcare companies because they are kind of so far back in like backlog, especially kind of in the past. I've done companies that had been kept afloat by like a lot of collaborations, and that just wasn't the case for
I
this
got
one.
2. I need 2
So that's kind of what I would say. I mean, that's pretty standard.
But is it, well, look, you know the industry better, but is it a little bit unusual for them to go this many years? Because I'm just looking back to
Well, I
2019.
would definitely
all the way
say,
to 2026.
I think a big part of it was those years like 2019 through 2021. As you can see, they kind of like took a little stumble because
Ask me
they
to wake
rely a
up.
lot on sales reps and rely a lot on sales reps going into the office and kind of getting, like, usually what would happen is they would like bring lunch for like a group of doctors or go to conferences and do stuff like that and kind of explain the product, explain the efficacy of the product. And that just wasn't really able to happen. So they were kind of calling them, but I mean, who's gonna take a call versus like being given a lunch? So I think that's
All right.
a big thing.
Grace is off the table. We got 4 more voluntold victims. Alex, you're first.
What's the risk of another company coming along and doing something similar for cheaper?
Where's our risk mitigation
Yeah,
specialist?
Alex, do you think that's more risk? Do you think it's
Where's that?
competitive?
Is that-
Who?
Margaret's risk?
Okay, risk. Okay.
Who's
Why
risk?
don't we hear from both? I mean,
Oh, that's a good idea.
Oh, you're saving, you're looking out, you're saving your colleagues.
Oh, wow.
Yeah, I think so.
What was the question?
What's the question? We gotta,
Like
Risk of
competitive
places
risk.
displays.
Yeah,
Yeah.
what's
Okay.
stopping anybody else from doing this?
I think one is the whole FDA approval process. So Cologuard 2014 that EXAS approved. You think about all the, I haven't fully looked into regarding Cologuard, but you think about all the money that you have to pour into something to make an at-home test compared to like a doctor actually performing Cologuard. Yeah.
That's good, Mike. That's Michael's point. I'm just kind of abbreviating. Good one is making at-home tests very complicated, and they've already got FDA approval for their current ones. So, kind of nickname poop in a box. So basically, they used to avoid. You guys have seen the little box in the commercials, and it goes into the bathroom. That's what this test is. You've seen this Cologuard thing. So, Margaret.
Yeah.
Your thoughts? Or
yeah,
is it
what's your
thing?
thought?
The risk of, I think it's just like my.
Oh, well, Margaret's still available then. She,
Ditto. Okay.
Ask me
Yep.
about
Okay, that's a
ESG.
good
Right.
question.
no, we got
Yeah, ask
ESG.
Margaret about ESG.
No, Bennett, that's all, Bennett, something else.
Then we got Tyler. I need a four.
To what Dr. Valentine was saying about how they're pre-revenue, and in terms of like.
Oh, you're at the team, I can't.
Or pre-earning, so then how do you also decide on your, like, using a 10-year DCF to get a four?
It's going to be FDA approved?
Yeah.
When is it going to be FDA approved?
Thank you. Yeah, so that was,
Oh.
yeah, so that's kind of one of the reasons why I had to do like a more,
Wait a minute, why is she answering? She's off the table. What was the question?
Our evaluation method.
Oh, we have a valuation expert over here who'd love to answer your question. Could you please rephrase?
yeah, why don't you use a 10-year DCF, August?
Yeah, well, Valentine
You can
mentioned.
stand up. You can stand up.
Yeah, so at the beginning of this, Valentine mentioned that with a company that's like in its latency, like Exact Sciences, you need to like account for the growth. Like, if we just did a 5-year DCF, it just wouldn't be fair because there's still like so much more growth in the terminal year. So we did 10 years so that we could capture once it gets profitable, it'll grow at like 2% thereafter, like after it gets some good profitable years.
What are you ESG?
Okay, so here's the question. So August, I have one more question for you. Please stand. So you guys use price to sales. Why is that not a valid valuation method? It's used by some practitioners, but it's really
Because
not valid.
that was the only one that I could use according to the flow chart.
Well, I mean, I didn't do price to sales.
Yeah.
Well,
But,
is price to sales.
I did, you sent me the flow chart.
Okay.
It was in your
so
flow
it's
chart.
not a great
Meetings, but I was-
That's a great with
they don't
consensus.
have-
This is why I was saying practitioners, I use price to sales.
Check the numbers.
Unless they do a version of 65 years ago, is that
Nope, Street just
price
uses DCF.
is the sales. Sales are used to
You can't
pay
do anything because
for
it's not.
the ultimate earnings for equity holders, right? And this is a good question you might get asked during the interview. So revenue, sales, is used to pay for both the equity, the earnings, but also pay for interest expense, which is the debt holders. So instead of using price to sales, prices for equity, you really should use enterprise value to sales, EV to sales. So that's a minor change. But I mentioned that in my notes to you just to know privately, but I thought I'd see if I could a little bonus question out of August here.
All right,
Okay,
who
next
asked that one? Bennett asked that, right? Tyler, I think you're next, and we've got ESG available and financial analysis.
I'll ask you guys about ESG then.
All right.
Can you just provide some color on management? Pretty low ball here.
Definitely doesn't know anything about it.
I definitely don't know anything about management, but I can tell you that they've been upgraded from a triple B to an A.
You don't know anything about management?
Not yet.
Wow.
And what else am I going to say about ESG?
The management's like pretty young.
Pretty young, and that's good for patents.
Yeah.
Earlier.
We gotta get some names.
The CEO's name is Kevin.
Like the minion?
Yeah.
Oh, he knows the name.
Oh, that's great. Welcome to the CFA team.
Oh, I'm not on the CFA
You are now.
Guys,
Okay, then somebody have
Kevin
any-
Connolly.
All right, well, last one we got somewhere over here.
Financial analysis.
Okay, fine. Skipping it. Financial analysis?
I had an ESG question, but
I look more of a company. ROI. I was gonna ask something else, but no.
Ask a ratio. We got a ratio master over here. He's probably got the spreadsheet up with all of them in front of his face.
I got them all.
Yeah. He's pretty good with math. He'll figure it out. What do you got? Fine.
Although,
Although if it's too easy, I'm pulling.
well, no. I guess when you're making your TAM for, let's say, Cologuard, what percent of people do you think just will flat out not get any sort of screening for rectal or cancer?
Joe?
Kind of cancer?
You're the last one. He asked you this question.
So it's based on, this question is what percent of people would just flat out just not get the.
Yeah, I mean, 'cause
You're on
like,
the team.
Yeah, I know.
it's not kind of
I
my
know the answer.
No one on the team knows. We'll have to figure this out as
I
a team.
know.
Last one.
Grace,
Sorry,
I
anyone
know.
left that's allowed to speak on the answer, then we'll get you the answer. Don't worry. Last one. We got a financial analysis question. There's so many ratios.
Give me a ratio you can ask.
Yeah.
Can you tell me about ROE? Well, considering that we have negative earnings.
Yeah.
ROE.
By the way, negative.
Next one, Alex.
Yeah.
Well, it's probably not generating free cash flow. Damn it.
They're not.
Language.
Next.
Next.
you talk about their debt to equity and do they have any?
Debt to equity.
All right, give me one moment.
I'm willing to bet because they've been losing so much money. I don't know if they have equity, do they? Book value of equity?
No, they do.
All right, so currently our debt to equity, I think is 70.
70% debt to equity. When's the most recent bond due? What are they paying for interest rates?
Interest rates,
And is it variable or fixed?
Oh my god.
And are there any converts out there?
I currently do not have those numbers.
So
All right. Thank you very much.
This is the baseline, guys.
Yeah.
I'm really talking about everybody but the five of them. Bringing these good questions next week, the week after, and even during Christmas
They
break.
need these questions,
Yep.
actually.
We'll be
It's
doing
good
this
for
during
them.
Christmas break, when we
They
call
just
you
don't
guys.
know it yet. Did you want to answer the question on the TAM to make yourself feel good?
Yes, it's Grace's last pick.
It's your bitch. It's up to you if you want.
Grace,
to.
tell us
Otherwise,
about the
we're good.
TAM.
No, that's okay.
Okay, we're cool. Good job on your.
You guys
Okay, so you got three down, three to go, right?
I know. It's like always an end.
Margaret, we, what time do you have your interview?
I have it at 2.
2 or 2:30?
2:30, but like, I wanna leave by 2.
Okay, so
We'll
after
go
this
along
team,
there.
go ahead, Grace.
I did
Okay.
say I
After
wanted
this
longer
team-
too.
Yeah.
You
Yeah,
did.
I'm a Mr. Bitch, sorry.
Yeah.
Good job.
Yeah, I know.
Alrighty. Hi, everyone. My name is Max Kruszeski, and with my mentees, we'll be pitching a buy of Manhattan Associates, ticker MANH. You guys want to introduce yourself and say what you covered?
I'm Mike, and I covered some of the moats and some of the Porter's courses.
I'm Dan, and I did the revenue drivers and the other Porter's courses.
Stock opened today at $124.79, which would shift upside to around 14–15%. And I found this stock through a FinViz screener of small to mid cap stocks, IT software companies with positive EPS growth, positive free cash flow, no dividends, and as well as positive ROE and increasing margin growth. I picked this company because Manhattan has a healthy balance sheet, no debt, And I saw this company as kind of a value play in the tech industry with steady EPS growth driven by recurring subscription revenue. They also have high retention rates and a reputable R&D team that has pushed out new leading edge solutions each year. My other pitches in the past have been a little bit more volatile and been dependent on companies breaking even through like one big explosion of growth. And that's not really the case for Manhattan. Their cloud revenue subscriptions are currently a majority of the revenues, and recurring revenue through their subscriptions allows for steady growth of EPS. My research was done on Manhattan's total addressable market and market share. The graph in the write-up got a little messed up. They kind of overlapped when they got pasted in. So if anyone wants to see that, I can show them. But essentially, the one that you can't see was showing a build out of all the Manhattan Associates customers and what they make in top line revenue. A little over a third of all of Manhattan Associates customers make over $1 billion in top line revenue. And that's it. I'll open the floor to questions. Sure.
Can you walk me through your DCF? What's the price target using your DCF?
Sure. The price target using my DCF is $109.94.
And how does that compare to the closing price was what, 120?
120. So the DCF right now is a little bit lower than the price it's trading at currently. This is kind of due to a couple of things. Change in working capital and CapEx are a little difficult to forecast out because of the fact that they don't spend a ton of money on CapEx because of the fact that it's a subscription software company. They have one main headquarter office in Atlanta, and if they're not spending more money on computers and desk chairs and office space, then there's no really big expansion there in terms of CapEx.
That actually makes your free cash flows higher.
Yeah, as I'm saying, there isn't.
Not having them should make your DCF be more valuable.
Sorry, I misspoke there. Depreciation, which is added, like I said, because of the fact that there isn't a ton of things to depreciate, they have computers and that's about it. The depreciation doesn't really drive free cash flow growth. It's pretty stable and steady. And I don't think that it's really capturing the value of the firm in terms of like its earning power.
Okay.
Sure.
But if that were true, and I'll return it back to Dr. Valentine. Assuming my free cash flow is very low, my CapEx spend is very low, that means my depreciation spend is very low, right?
Yep.
But if I had really high CapEx, I'd also have really high depreciation. Those two things often run at a ratio that's not that far off of 100%, which means it's not dramatically going to change your DCF, which means what you just pitched me is not true. Help me understand why you're still pitching downside on the DCF. Is it because it's 5 years? There's something else that's
well,
that.
My 5-year DCF originally was projecting a lot of downside. I then shifted my DCF to a 10-year model after working with Mr. Walker.
Wow. And you still have downside.
And I still have downside, but not nearly as much as I had originally after a 5-year.
So that was going to be, I actually didn't ask the question, but my question was going to be, if I'm a portfolio manager and you come to me and I'm about ready to invest $100,000 and you say your DCF shows 10, 15% downside, why would we want to invest in this?
Because I think the relative valuations of PE and price of free cash flow project the upside of the firm a little bit better than my DCF.
But what did you miss? I'm sorry to keep harping on this,
Yeah.
right? But if that's true, let's follow the logic stream. If the street has it right, so to speak, the competitors are reflecting reality better, then that implies your DCF has actually missed something. It's mispriced. So what do you think you might have? Let's start with the basics. What does the street have their DCFs at in terms of valuation? Maybe that'll help.
Right around $130.
So what is it that they're doing different than what you're doing? Because that'll help us get a gauge of what it is that might be disconnected, right?
Sure. In terms of specifics as to what,
there's got to be something driving that $20 difference. If you look close, there's going to be one of the categories, I'm guessing, that's pretty different than yours. I'm not saying you're wrong, you're probably right, but I just want to know what that is so I can understand what's the difference here that we're pitching.
My assumption would be in overall margin growth. I have a little bit safer of a play. I think that the company will continue to invest in R&D because of the fact that they are competing against some software powerhouses in this firm, and they need to capture market share and to keep subscriptions going. They need to invest more and more into research and development and marketing strategies to keep customers coming in and to keep customers that they have. They've done a good job with this in the past. Retention rates are upwards of 100%. and they have 5-year. Most of their subscriptions are 5 years in length, and I think they've done a great job of this. But I don't think it's the point where they need to stop investing in these things. And I think I'm anticipating more investments than the street into those things specifically.
So on those lines, because it sounds like you're more optimistic on some of these things, what did your proprietary, or even just not only proprietary, I don't know to the level that I can call, this goes for anybody, I can call proprietary, but your research you did that was not from the company, how did that inform you on your ability to be above consensus?
Sure. So the research I saw was data on subscription revenue market share in the supply chain management field. Right now,
across the whole industry.
Across the whole industry for all.
Where'd you get that?
That came from. I don't have the source in front of me, but I have the chart. I can pull up that source for you after the fact.
Okay.
It's not.
I think it was supply chain something.
Yeah, it's supply chain. I quoted it in my writing here.
Okay, but
Allied market research for supply chain.
Okay, so you were able to find market. You're able to identify TAM. Is that what you're saying?
Yep.
And so you got that, and then what did you do to be able to come up with something that didn't come from the company?
Sure. So the total addressable market, I calculated that off the data I found, and then took total market share of Manhattan Associates, which is the 2.3% they were getting in cloud subscription revenue, plus the remaining revenues they got from their other business segments. And then I calculated a theoretical maximum that Manhattan Associates could get using this market share in their cloud subscription revenues, and calculated where they're currently at and where I believe they should be or could be at.
And what informed you on that? That's what we're trying to get to. Is that there were some numbers in your model that ultimately were going through. You took some industry data, which was good. Mm-hmm. You took the TAM, and then you said, I think they're going to get X% of TAM, which is also makes sense.
Yeah.
But what informed you to whether that was a big number or a small number?
Nothing outside of the 10K in that regard. I was just I looked at historical performance of research and development, things they've done in the past. They pushed out. They're the only supply chain solution company right now that has working AI and machine learning capabilities. Oracle, SAP are working on it. They don't have it out in the public right now. That's something that I saw as a strength for Manhattan, and calculated that because of this, that they would capture more going forward.
So based on your strengths.
Yeah.
Okay. Other questions?
So I'm going to go back because I'm not trying to get too belligerent, but so if I looked at your DCF then, because I think I'm understanding what you're telling me, the revenue numbers are going to be higher than the street or not?
Correct. My revenue numbers are.
Okay. So again,
I have percentage of.
If I have higher revenue, $100 worth.
Sure.
What's R&D percentage? Is a percent of revenue?
About 45%.
Okay.
50%.
So I lose 45% of that to R&D. I get $55 left I didn't have before, right? If I had more revenue, do I ultimately end up with more net income in general in this company? If I sell more stuff, do I make or lose off every dollar I sell?
You would still make.
Yeah. So if the street is higher than you, but you have higher sales than they do, something's just, this math isn't adding up, logically speaking. I'd like to take a closer look at the DCF1, or try to figure out what those differentiating factors are. And then two, along this different path, but same vein, if we go down and say, okay, we've got this whole forecast, and I think they have this really cool AI ML product that no one has. This is more of a general comment for the class. We just had our first class today on it, so I don't expect you to have done it, but in the future, strongly consider taking a look at their patents and then coming up. We've done this one time, a modified version, right? Joe tried it's called a modified DCF approach to figure out the DCF value, but you put a bolt on for the IP value of something that's your departure point. I'm departing from the street. I've got a 109 DCF, Dr. Valentine, but turns out the IP value, the AI ML, I cash flowed it because no one has it. I made a 5-year DCF on those cash flows, and that gets me to 130. Cool. You'll do this kind of stuff when you get to your firm. It's something to consider for the future, not a criticism, just a comment.
Gotcha.
Yeah.
Other questions? Go ahead.
From 2017 till now, the operating margins have fallen from 32% to 18%. It looks like you have that reverting going forward.
Yep.
Why have they been falling, and what's changing to allow them to come back up?
Yeah, so operating margins are falling because there was costs associated with getting rid of their licensing revenue. Their licensing revenue is essentially like a one-time purchase for a certain amount of time for their equipment, and there was a lot of costs associated with getting rid of this in terms of people paying. We needed to pay people to go out, or Manhattan needed to pay people to go out and get rid of the systems and change them over into the cloud format. So I think in that scenario, margins have decreased because of they're almost completely shifted out of it now. And once that shift is complete, which I believe it will be shortly, margins will begin to expand again, as they won't see those costs associated with like the closing costs, if you will, of getting rid of the licensing software.
Great, thank you. Just due to time, I want to make sure that the mentees get a chance to give us their thoughts. So each one of you guys want to give us just an insight about something you learned about the company that we might find insightful?
So I think I did the most, and I think one of the really cool things and really good things about the company, along with some of the management, is that they have high switching costs, which is high risk, but it allows for when somebody signs on, it's a non-cancelable. So over time, once the contract ends, it takes a lot to switch softwares. So a lot of the times, customers end up sticking with Manhattan and maybe go for a cheaper option.
Yeah, sure. Great, excellent, good.
Yeah, they're the highest percentage of their revenue comes from their maintenance, which is like.
You said maintenance?
Yeah, it's like they're updating softwares, the new Manhattan softwares, and then their highest growing revenue driver is their cloud services, which in 2020 grew 70%, and then in 2021 grew 53%. Oh, I mixed it up, 73% in 2020, 50% in 2021, and they're really pushing their cloud service softwares.
Great. Well done.
Oh, yeah. All right, guys, let's get it.
Oh, he's actually pitching.
All right, hi, my name is Bassel Fouad. These are my mentees. Introduce yourselves.
I'm Tess Dillon. I'm Sarah.
All right, so today we'll be pitching PureCycle Technologies.
So what is it?
PureCycle Technologies.
PureCycle, okay, just slow down a little bit.
Oh, yeah, sorry. Okay. So I'll be pitching PureCycle Technologies. I think the number one theme that I had for this was how did I spring for this? I really had a passion for patent law, and I was actually going to go to law school after this, go into IP law. And there's this website called Harriet Phillip IP, which essentially tells you like what companies have the most intriguing stocks based off their patents. And that's where I found PureCycle Technologies. So I guess we'll open the floor to questions.
Okay. Oh, Ignis.
Hey Basil, great job. I guess my question's gonna go around your valuation methods.
Yeah.
So with your DCF, you did 10 years and you got some pretty massive downside, but then with your EV to sales and EV to EBITDA, you got what looks like pretty good upside with the first one and at least some upside with the second. Can you talk about maybe like the differences and why maybe you got massive downside with the DCF, but then some upside with your other methods?
Yeah, for sure. I think the number one thing that, especially that PureCycle Technologies is going through, is that they're going through a build now mode, right? So they literally have no facilities open as of right now. And the reason why my DCF was giving me so much downside was because in the next 10 years, that's when they're actually going to expand on their plans, giving me the CapEx depreciation from there. That makes sense. EV to sales and EV to EBITDA. The reason why those are giving me upside is for the sole reason that this company is actually the only people that can actually recycle polypropylene this way due to their patent. So with that being said, the reason why I did EV to sales and EV to EBITDA was for the sole reason that I wanted to figure out what's the actual piece and what's the actual consumption rate that these consumers are actually going to go in and to actually purchase these recycled resin pellets from PureCycle Technologies.
So then to follow up, how long down the line until like you would recommend maybe pitching this as a buy?
Yeah, so I personally believe that we should look into this into Q2 of 2023 for the sole reason that we'll actually have a nice trend of what's actually going to happen within the next year or so.
So I'm going to follow up on that because then I just want we already talked about it, so I suspect Bassel knows this is coming. So remember we watched the two analysts that were pitching on CNBC towards somewhere midway through the semester, the sophomores you saw earlier in the semester, where there was the Tesla analyst and the Netflix analyst. And remember the Tesla analyst was saying, I'm on the sidelines, I'm watching the show, I got to wait until I get more information. And I remember I was kind of going crazy. I'm like, no, but if you wait until all the information's out, it's kind of too late, right? Now, I don't think this is one of those situations, but I wanted to kind of set that up because once again, I've already had this conversation with Bassel. Why is this not one of those situations? Or walk us through how are we not going to just simply wait until all the good news is in the stock's moved up, and then we're like, okay, now it's time to buy. In other words, what are we going to look at that is we can look at before CNBC and everybody else sees it?
Yeah, so personally, I wanted to rate this as a sell because they have less than 1 year of cash runaway. They have no revenue, unprofitable for the next 3 years. And I also noticed that shareholders have been diluted in the past year. These are tremendous warnings that this should be a sell. But what's going on in the background that people are not seeing is the actual valuation that this patent is going to actually have for PureCycle Technologies. The reason why we should wait on the sidelines is because we have an equal amount of opportunity for massive upside potential. Yet, if we're coming at this from a risky perspective, this is intended to be rated as a sell currently right now.
So what do you think we should look for other than them coming out in a press release saying, we opened up our plan, everything's working great, and the stock moves 20% that day? What can we do before that?
Yeah, so I think the number one thing that we should wait is during Q1 of 2023, when they actually released their statements on what the actual processing plant infrastructure was, if CapEx is extremely higher than consensus was figuring out, then we should sell the stock.
Okay. And you have a source out there, though, that was giving you an idea of kind of how things, by the way, if a company's doing, part of the challenge here is this company's plant is not opening up. If you get sources out there, they can look at it from a distance and say, the plant's not opening up. We can see the equipment's still out there. Couldn't we do, like you've already talked about some of your sources that are out there in Ohio, right?
Mm-hmm.
What could we do potentially with that source, not inside information, to give us an alert before they actually release the results? We have to read it like everybody else does.
Yeah, so I think the number one thing that going into this perspective was Acres is the construction company that's currently doing the excavations, and they have extended their contract into the next year of 2023 for Ironton, Ohio. If I revisit this in Q1 of 2023, or if my mentees actually take this away from me and hopefully do a better job than I did, they would actually go into Acres Solution, just contact them and have the quote-unquote insider information that I had. If their contracts have been extended out more, this is clearly just a sell.
Okay, and I should mention, that's a gray area. If you call up the construction company and you say, did you get another contract with this company, you probably are going to have inside information. But if you were to call a company that's in that area and say, look, are these guys still doing work out there? Or how much work have they done? Or you fly drones over or something like that. And that's kind of where I was going to go, is if you have sources out there that give us an idea, aside from getting inside information from the company, it might be helpful to know before.
Yeah, so my uncle actually owns one of the largest construction firms in Cleveland, Ohio, and he actually knows the person that owns Acres Excavations. So that's how I got the information from there.
Which is good, but you don't want to have community get inside information.
Oh yeah, well,
we're recording right now.
What, 10 people watching at most?
That's 3. We've never had 10 people watching.
We can rewatch
it.
We
Like,
save that money.
Yeah.
That's it. Okay, well.
Save out of your future career.
You're right.
Never gonna work in financial services again.
Wait, but if you show up on Saturday, look at
Wait, what?
look at it again. It's like,
That was weird.
Other questions?
do you use any option valuation on this?
You know, the thing is that I wish, and I'm actually looking at an option to actually go into the $7 strike price when valuing the Black-Scholes model.
Well, back up. I'm not asking about the stock. I'm asking about the value of the patent.
Oh,
the value.
Yeah.
Options to value.
Yeah, so the reason why I didn't do that was because there really is no correlation when it comes to the patent and to the stock price. I think as of right now, the biggest theme is when is the actual plant going to open up? As of right now, this stock is currently an idea that is coming into fruition, not an idea that has become into a fruition. So we don't want to have a Matterport 2.0 in our portfolio again. If that makes sense. And this is just like an insider joke that I pitched Matterport. and it was terrible. So this
Well, let's not talk about that.
yeah.
Mark.
We have a question coming in from Kendra.
Yeah.
She's wondering why you felt the need to, so for your valuation, she's wondering why you felt the need to differentiate between revenue and EBITDA.
Oh yeah.
And driving the valuation up, and what happens if you stripped this away from the valuation?
Yeah,
Like the
so
TCF.
I actually texted her that this morning. So I will pull it up as of right now.
Sorry,
So
why is Kendra dialing in? Where is she?
She's class.
Oh, okay.
So essentially, I needed every piece of the puzzle since this is pre-revenue. EV to sales measures the cash generation, while EV to EBITDA measures out the operations since they're in this build now mode, if that makes sense. And essentially, if I was able to actually strip out the EV to sales, I would actually get an $8 valuation. If I was able to actually strip out the EV to EBITDA, that would just essentially give me a price target of $6.27.
Oh, wait, never mind. We
Yeah,
talked about
I
it.
got you. Next question.
I think I'm gonna ask your mentees to give us a thought.
Oh, yeah.
Well, I could start, I guess. I think this company is pretty cool because they act kind of both as environmental service and waste management company, which is not very common. And so they have a very different kind of operational strategy that they're not hitting yet, but then other waste management companies, which kind of gives them an economic edge.
Yeah, just going off what Tess said, I think their patent is really interesting and the fact that there's nobody else recycling quite like them. So I think in like coming years, seeing that companies are trying to move more environmentally friendly, it'll be an advantage for the company for the future.
So I guess one question for my mentees. So when you're looking at this company, and the biggest risk I'd say for this company is that they SPAC'd in 2020, right? With what investment bank, if you remember when I told you? With the that gave them the highest buy rating, right? Don't you think it's kind of very risky that management has also had 6 other SPACs into this as well? What would you say for that? Like, do you have any faith in management? Have they done anything differently? Is there any new management?
Yeah, so we did talk about this and we talked about the management and how they've changed and they've kind of altered. We also talked about how everything was cheaper in 2020 and so moving forward. And Bassel also talked about how in his model he made the operating capacity and the other capacities a lot more conservative so that going forward just gives us a better model.
Yeah, and who's your CEO again that was recently new? Dustin Olson, correct?
Dustin Olson. Yeah.
Dustin Olson, correct.
Okay, so that's good. So I have a question. Let's get back on track here. So you referenced a 2026 price target.
Yeah.
Did you discount that back to present?
Yes, I did.
Okay, so it's not really a 2026 price target, right? It's a current price target, it's a 1-year price target?
Yeah, so it's a 1-year price target.
And what did you use to discount it back to present?
Yeah, so essentially, when especially.
So what did you use? Did you use the WACC or cost of equity?
No, I actually used the WACC.
Cost
of equity. Here's why. Here's why. Chill out. You're picking. So when looking into yeah, well, the reason why I actually cost of equity is essentially about 86% when you're looking at that. So at first I did the WACC, then I looked at cost of equity.
You should have cost of equity.
Yeah.
Because you're looking at the equity, or in terms of discounting back a stock price.
Yeah.
Okay. Other questions?
How much does it cost for them to acquire cost of PureCycle in the first place?
Yeah, so they actually have a feedstock plus margin. So for every pound that they actually get, or let's just say for every dollar that they have, it currently costs them about 22 cents.
We got a question.
Oh, wait, Jake, what's your question?
Wait, no, we got a question.
I'll ask him offline.
Was it gonna be a softball question?
Well, I was just wondering why I didn't like screen for a buy. Like that's
Why did you buy? Because I said it in the first minute.
I mean, but why?
Bassel likes to pitch things that we can't buy.
Just while we're getting ready for the next one, I will say there's a little bit of what's going to teachable moment whenever these come up. So there was a student, I won't say who, but that pitched here just a minute ago, who came to me quite eager with a strong buy rating on the stock. And after he did more work, he kind of came around full circle and said, now it's a strong sell. And then came around and said, maybe it's a hold. And I want to bring it up not to call that student out.
It was me.
But more to say that this is the whole field of behavioral finance can be encapsulated, or at least big chunks of it, into this whole idea of this optimism bias, confirmation bias. We try to find things that confirm our optimism, familiarity bias, all kinds of biases and aversions that are happening here. So be careful about not predetermining your rating just because you like the story, but instead make sure you understand the stock, the valuation. Okay. Yeah.
All right. So
Max.
today I'm pitching Celsius Holdings with my mentor Lupe. Target price 124.42, representing 22% of upside. Just kind of get in how I found the stock. Celsius Holdings.
Celsius, okay. There was a can, but I got in here early this morning. Someone left a can of Celsius sitting here on the porch, but sitting up here. So who drinks Celsius in here? Okay, so a lot of people. Okay, so
Margaret loves Celsius.
Okay.
Oh my God.
You cannot buy it on Amazon Fresh. I tried it, so I don't know where to get it.
That's like where
You
I
can
would
buy
get
it off of
Yeah.
Amazon. It just
Yeah.
won't come Amazon Fresh, but it'll
come in
sometimes
cases,
there.
and you can get the powder.
Costco.
The powder is the most.
I'm on strong back.
The powder is the most like.
It is really good.
It
It's the
tastes
same
really
much
good,
as
and
a
you don't have
can.
to deal with all the fizz if you're not into that.
Sorry, man.
It's a great product.
Are we good?
Like X-Men,
Okay. Just to get into how I found the stock, Celsius has been something I've kind of been looking at for like the past year. And it was actually in the portfolio. And then it got sold, thankfully, so then I could pitch it again. But kind of the main driver behind it was just having this whole PepsiCo partnership, with that kind of driving their sales and demand and market share. So kind of seeing that they had made that partnership as the biggest driver for me, and then I thought it was a good idea to pitch it. So with that, I can open it up to questions.
Great. So I have a question here. So in this, once again, forgive me because some of these questions I put together, I was one of looking at your drafts, and maybe you've resolved this, but at one point you were thinking the store growth. Someone else go. I'll get the other question here. Give me a second.
So since you said like we previously had it in our portfolio, were you able to kind of go back and look at maybe like their previous price targets and kind of like what they were thinking, and then maybe like why we sold it, and then like why we're buying it again?
Yeah, sure. So I didn't actually look at the actual pitch, but I know when we sold it, the performance was down. But kind of take the past month, Celsius up 25%. But then going off this PepsiCo partnership is very new with it happening this past quarter. And I just think being able to leverage the expertise of Pepsi and kind of being able to target their markets is just really going to pay tons of dividends and really increase demand and that market share. And that partnership happened, call it a month ago. They've already seen kind of sales this past quarter increase 100%. And then they just have.
So hold on. Partnership just started a month ago, and they're already seeing benefits.
Through the 3 quarters, they've seen sales kind of basis.
When did the partnership actually become effective? Because there's one thing when you announce a partnership, and then very often it can take like 3, 6, 12 months before it actually happens. So are you saying it's actually effective already?
The partnership has become effective over the past month. I guess I misspoke on the sales that year to date, it's 100% increase.
Okay. So am I looking at Celsius Holdings, right?
Yeah.
So they're losing money, right?
Yes, they are currently, but half of that is because they had to pay off their prior distributor $150 million just to terminate that contract.
Okay.
Why'd they terminate the contract?
Because they have PepsiCo distributing their
Oh,
sales.
wow.
So how much do you think that this PepsiCo agreement is going to lower Celsius's operating costs?
Their operating costs? I think the big thing that's also kind of driving my decrease.
Or distribution costs.
I think the big thing too, or kind of my first answer there would just be, historically, Celsius has been able to operate at like a 47% gross margin. Right now, they're kind of operating at a low 40s. And I think just.
Sorry, can you walk me through? So I want to make sure, is distribution cost part of that, or is it considered below that?
It's part of it in the cost of goods sold.
Okay, so you said they've been operating at what?
Historically, like 47%, but right now.
Gross margins?
Yes.
Okay, and you think they're going to go to where?
I think they can increase it all the way up to around 48, 49%.
Okay, so go a little bit.
Yes.
Okay.
But then,
and how do you, my real question is, how do you come to that conclusion? Because you've got optimistic growth, earnings growth, and I'm trying to understand is due to this lower distribution costs. I'm trying to figure out what informed you on that getting better.
Just the way Pepsi delivers their products. So right now, Celsius, before the partnership, had a more typical delivery system where they had to distribute their products to a middleman, and then the distributor would ship it to retail stores. Now with the PepsiCo partnership, they can do direct store delivery, so they can go straight from their kind of warehouses right to the retailers, kind of cutting out that middleman and shaving on distribution.
And is that something that the company told you, or you kind of figured this out on your own, or
No, that's just
reports?
That's just kind of how Pepsi delivers their products, and that's just the big thing of kind of one of the strategic rationales of this partnership was that they could take advantage of this direct store delivery.
Okay, good. So what I'm trying to understand is how does why is this not already in the stock? Because if this is really obvious and you can just figure this out by reading the company document, why do you think this isn't already reflected in the stock price?
That's a good question, but I think I think part of it too could just be within. Granted, that is the first month of the transaction and the partnership. They're still kind of working out the kinks, if you will. So the stock really hasn't taken that full advantage of it yet. And then
I thought you did some kind of unique work or some work other than just reading the company documents, didn't you?
It was not that all this direct store delivery stuff was not company documents. It was more just kind of going into like focusing on direct store delivery and just doing research on that.
Okay. So this is a good point. Sometimes you guys, when you do work, this goes for analysts too, is you'll find something where you think you have a competitive advantage in your forecast, or you figure out a catalyst others don't, and that you want to make sure you highlight. But I think what Max is saying, but in addition to that, here's a catalyst that everyone kind of knows. So you just got to be careful of separating that. If you're going to say, look, I think part of what's going to drive the stock is it's PepsiCo, it's going to lower distribution costs, which the street already understands, blah, blah, blah. But then I also think, and this is where I want to hear the other part, I also think why is going to happen because of some work I've done. Can you walk us through whatever why is over here?
Yeah, so then why is just kind of the sales aspect of things and kind of the demand and the market share. So the research I did was looking at prior PepsiCo partnerships, specifically the Starbucks one, and I saw that basically Starbucks and PepsiCo reached a similar agreement in 1994 that basically gave Starbucks complete control over, or they gave PepsiCo complete control over Starbucks' distribution. So think like at retailers, you can buy like little Frappuccinos in the glass cans. That's PepsiCo's doing. And so basically I went back to the Starbucks' 1994 10K and just looked at the years following, so like 95, 96, how Starbucks had done. And granted, they have their retail segment and they are a completely different business model, but years following, they saw a 62% increase in sales and 110 increase in earnings. So I thought that was a sign to me that one, PepsiCo kind of has experience in this transaction field, and then I also thought Celsius and Starbucks, being in the beverage industry, having these disruptive products, were kind of similar.
Okay, good. And you did a survey, didn't you?
I did do a survey.
Okay, well, show that off.
So the survey was just basically kind of to gauge the market share and see how people kind of responded to Celsius. And so kind of the three key questions I asked was, one, how have you heard of Celsius 5 years ago? And that was kind of a resounding no, like really no one had ever heard of it. And the next one was
the company around 5 years ago?
They were, but had less than 1% market share, really just were a non-factor. Okay. And then the next question was, would you choose Celsius over competitors like Monster and Red Bull? That got 88% yes, would choose it over competitors. And then the last question was, have you seen Celsius become more available in the past year? And that got 92.5% thought yes, it would become more available.
Okay, really good, well done. It's not an Amazon Fresh, but it is more available. That's good. Okay, other questions? Okay. Does your mentee, hold on, your mentee would like to give us a thought or two, what you learned?
So I did the revenue drivers, and I saw that Amazon, well, you were talking about how they don't have it on Amazon Fresh, but they actually hold 18.51% of the market share, which is more than Red Bull. And Red Bull has actually been in the market since 1987, so it's kind of impressive to see the growth that Celsius has been having. And also, most of their sales are coming from North America, but recently they had an agreement, I might butcher the name, Kaifeng Food Technology, and they will be expanding to international markets. And lastly, their market share is growing, which will lead to an increase in their revenue.
Great, well done.
I think so.
Who else? Is that it? That's it. Okay, great. So, by the way, before we go, so for next week, because it's going to be the last time we'll ever be in the same room for nostalgic reasons, we're going to take a picture. So please get here about 10 minutes early next week for